Welcome everyone to another session of It Depends. So every single month we have a session with our SARE advisors, Tony Hoong with the CPA Dude and Davis Yu of DY Law, where we have topics that's relevant to real estate investors. So this month we're really lucky because we just finished SARECon just about a week and a half ago. So we're all a little mentally recovering from that. But we're really happy to have Tony do a presentation for us about how taxes work for out-of-state investments and syndications, as this was a huge topic that we've been seeing a lot in conferences and in meetups and at SARECon. So without further ado, Tony Hoong.
All right, thanks for the intro, Annie. All right, so we will be talking about out-of-state investing today. Let me share my screen for tonight. Let's see, this one. Cool. This one. All right, can you see the screen okay on here?
Yep, looks good.
All right, sounds good. All right, cool. It depends. All right, so tonight's agenda is going to be talk about out-of-state investing, tax implications that you need to watch out for as you're investing out, syndications, if you're getting into syndications, and then if you're forming partnerships or if you're co-investing with other friends or buddies or just random strangers. So just understanding the tax implications of this. With our good old disclaimer here, everything is educational purposes. So it's just more so for jokes and fun, but contact your own CPA, or you can hit us up later too if you got more questions for, your own fact situation. So let's go right into out-of-state investing. So more and more as the house prices get up and up, there's not a lot of money doesn't go far in California. So getting in out of state, finding areas like in the Midwest to invest, if you're in the West Coast, or, if you're just getting into Florida where a whole bunch of folks are, hitting it, but you live in a different state, you're out of state investing. What do you need to, realize while you do these things? So the first one would just be your other state return. So now you have an extra state non-resident return that you need to file, unless you actually move to that state. You might be, partial resident. But in general, just make sure all your state returns are going to be filed on time. But there's also a tricky thing of this. It's like, generally speaking, like your rental properties, if you have a mortgage on it, you're going to have interest plus depreciation in your insurance and operating it all. So it's going to end up in a net loss anyways. So it's kind of up to you on, do you really want to file more state returns or not? So, sometimes your CPA is going to charge separately for it, but it's just to lock in losses. So it's kind of up to you on if you want to pay to have that compliance part done, or I'm not sure. I don't know if TurboTax charges separately for each state return, but just be aware that once you're investing out of state, you'll have other state returns to file. The next thing that you want to look out for are your local taxes. So specifically, a lot of folks that are in the short-term rental Airbnb space, there's all these city and county level taxes that aren't part of your income tax filing, but are part of your transaction taxes. So transaction taxes, what those are just, transactions assessed on each time you have someone come in. So, if you ever go to a hotel, if you actually go pull up all the taxes that are associated with it, they itemize each one because there's a lot of special taxes for hotels. So there could be a lot of special taxes for your Airbnbs, short-term rentals. So just watch out for your local taxes, specifically your city and county, generally speaking, more than county. And then another compliance item that you want to look out for is going to be your business licenses. So you may need a business license to operate in that locality. So, just wherever you're investing, just put in that city plus that county, and then maybe just tax requirements. What else is the transaction tax requirements? So just watch out for that to make sure you're fully compliant before you're not. And then there's a more tricky part. So if you're in multiple states and say you're actually in an income position, there are reciprocity between states that you want to look out for. So instead of saying you live in California and then you also have, property, say in Iowa, and that Iowa property is also doing well. So if you paid taxes to Iowa, then on the California side, you'd be able to take a tax credit against the Iowa taxes. So you're not double paying. So most folks that once they get into out of state, or if they work two jobs and they travel for jobs as such as a consultant or a travel nurse, that's when I usually see this missed. So just remember, trigger your taxes paid to your state. Otherwise, you're just be paying double the taxes for where you reside yourself and plus where your property is. So a little just tip there. And then a little fun one for everyone is like, can you, take some write-offs to go travel to that property? And, if you're visiting there on business purposes, so say if you have a property in Tennessee and you're like, hey, let me go out, I want to go check out the property, see the condition, walk through it, probably a good idea to probably see your own properties, but some people invest and they never even go view the properties. But it's a good excuse if you want to go visit that city and also get some write-offs when you go travel there. So, your flight, your hotel, food away from it, you'll be able to get some more write-offs that way. So make a vacation of it, maybe pick a city where you want a vacation in the future. And there you'll be able to double dip it and kind of go in there for the travel write-offs. So another way to just, where do you want to invest here? So out of state investing, it's nothing is like crazy. This is more more compliance that you have to do. So just watch out for your state returns, local taxes, and then have some fun with the write-offs to go there. Okay.
Tony, a question about the write-offs of travel. So pretend that, I'm just a new investor. I haven't invested my own property. I have my own though. And I want to go and check out properties to purchase or meet with real estate agents. Can that be a write-off? Like, do I need an LLC or do I have to have an investment property before I can do that?
Yeah, so you'll want to, if you don't have a LLC, like one, you don't need an LLC to write it off. You can just write it off on your Schedule E on the personal level. However, if you don't have a property to peg it towards, so you didn't actually close it, then this wouldn't really work for you because you don't have on your Schedule E like what property to assign your travel costs towards. So in this instance, it wouldn't work. But if you did end up closing on that property, now you have something to peg that directly towards. So, I would just keep track of like, where you're spending, where you're traveling. And then if you do eventually close in that city, you can do some allocations towards that.
So that means if I understand it correctly, is if I do own a property and real estate property, I go and check it out. If I don't close on it, then it's not write-off. But if I close on it, then it becomes a write-off.
Oh yeah. So say if you're Richmond, then you go to like Seattle and you don't have a property yet in Seattle,
Mhm.
but then you end up closing on a property in Seattle, then you just write it off since you're scoping off properties. But say if you already have an existing, not a new property, so say you go to Texas and you're gonna go visit, do a site visit, you can write that off because you already have that property. So the biggest thing is like, where are you going to be able to assign that cost towards?
Okay, then pretend you know that I have a property in Dallas already,
Oh
and I'm
yeah.
flying to Dallas to check out other properties to buy and meeting, the CEDOs like normal, but I don't end up buying another property. Can I take that trip as a write-off and apply it to my existing Dallas property then, or like the rental income?
Make a pit stop and do something there. Yeah. Then you're able to then you can scope out like, hey, property's doing good, just doing an inspection on it, and then you're able to write off that portion.
Is it also including the food, or and like me getting a rental car, or are there limitations to what I can write off?
So the food that's business related you can do. But if it's like you just hanging out type of food, you wouldn't want to write that off. The incidentals of such as like the car to get from place to place, plus the plane, plus the hotel, you can write that off.
All right, you guys heard that. So come travel with me. I'm going to Dallas in October. I will create a lot of write-offs for you guys to come with me.
Oh, there you go. Dallas trip. Yeah. Or come to California if anyone's actually going to buy a property here.
Cool. Thank you.
Mhm. All right. Cool beans. Oh, Kevin's got a question. So basically, if I don't close on the house, I can't write off the travel. Correct. Because like on your like when you come to tax time, like you don't have a place to peg it against. So as if you have a place to peg it against because you traveled, you close on that property to view it to make sure like roof's fine, siding's fine, sidewalk's fine, then you'll be okay.
So when you mean it like that, though, when you're saying pegging against, does that just raise my the basis cost point of when I actually purchase it or when I purchase the property? Like how does that part actually work for
Oh,
deductible?
yeah. So you would just expense it directly. It wouldn't be a capital improvement or increase your basis. So yeah, it's just a normal write-off against there.
But there's no income in yet though, because I had just brought it. So it just comes as an active loss in the first year for that.
Yeah, yeah. Uh-huh. Yep. As long as you placed it in service. And then if you have 1 month's rent or if you have no month's rent, but as long as you place the unit in service. If you didn't place it in service, then you don't then you don't get it.
Makes sense. All right,
Yep.
next question from Wilson is, do investors usually purchase the investment property, then transfer to LLC? Is it safer to have a write-off or doesn't it matter?
So maybe a Davis question, but generally what I see is that people will buy it and then they'll ask me like, oh hey, can I transfer it? So you can definitely do it that way. But if you have the ability to buy it in the LLC's name, that'd be easier, less paperwork. But generally speaking, most people I see it's in their personal name. And then once it's in the personal name, then they'll transfer it over. But then some people are kind of just spooked right now, just in case they call the loan and then it actually gets like boosted up at the 7 or 8% rate. So probably contact your bank on there just to make sure nothing's going to happen. But it's transfer wise, that's generally wise. You see it bought in personal name, then transferred over to the LLC later.
And then also for Wilson is the question about usually they purchase an investment property if it's an LLC. It really depends on your lender because if you're going to buy it through a conventional loan, like the 1 to 4 units, you're buying the standard 30 years, the banks often will not let you close in an LLC or your lender. So you have to double check. And the ones that do, they usually do charge more. Or if it's a commercial property, then you can close in an LLC or like a DSCR. So it just really mostly depends on your loan.
Nice. And then, oh yeah, second part of Wilson's question was safer way to have write-offs or does it matter? So for tax purposes, it won't matter. You get the write-offs regardless. Cool, cool. All right. And then Sunny's got, can I write off expenses if my wife is rep? So as long as they're business expenses related towards, the real estate professional activity, then yes. As long as they're just not personal in nature. As long as there's a business use. So if it's ordinary necessary for that activity, especially what arm of rep are they, from a realtor side, managing operations, rental, acquisition, all just depends on like what type of activity there. So, but as an agent, yeah. Mhm. Cool, cool. All right, all right. Sounds good. So out of state investing. So let me go to the next slide there. If anyone has any other questions on out of state investing, let us know. Okay, so syndications. So a lot of easier ways to start investing is through syndications and just understanding a little bit more on like, hey, how does it work mechanically from a tax side and what you should watch out for. So the first thing, like a syndication, the whole point of it in general is make it easier, right? You're a silent investor, don't have to go source the deal, manage the deal yourself. You're just a silent investor. So you'll get a form K1 on the property. So the K1s in itself is your way of reporting it. It's a relatively simple form. You'll just go on your 1040. But do be aware, like once you kind of get into syndications, generally speaking, that your returns can be extended. So because most CPAs extend partnership returns. So unless that CPA is just getting it done out and fast quickly, be prepared to extend your taxes. So once you kind of get into syndications, you can pretty much expect your taxes to never be done until October ever again in your life. Because generally those K1s probably come out in the summer, by the latest it's due 9/15. So just be aware of tax filing which means that you should have your estimated taxes ready. Because when you extend your taxes on 4/15, it doesn't mean that you have more time to pay your taxes. So you have to run like a pro forma / projection with the best data that you have, extend your taxes, pay your taxes on April 15th, and then just sit and wait. If you're savvy, like some folks, they have auto text reminders somehow set up on like some fuzzy logic. aka Mr. Nelson. So he showed me some really cool way that he programmed that. So K1s, be aware of that for which you need to have. And on the K1s, going back to the out-of-state example, these K1s more likely than not are going to have losses associated against it. And once again, it's kind of up to you on, do you want to file an extra tax return for, say, you pick up like a $30 loss? Is it really going to be worth it for you to file a tax return or not? So, weigh out your options. In an ideal world, if resources are not constrained, then file all the tax returns. But if they are constrained, probably just pick the ones where you want to lock in losses. Then, yeah, other state returns, like I said there, it's just, hey, making sure that all states are going to be there. Just be aware of your filing requirements. There's a thing called composite level taxes. And what that simply means is that you can elect for the partnership to pay taxes on behalf of the partners level. So you don't have to file anything on your personal side because they'll be filed and handled at the partnership level. So watch out there. Syndications, also, generally speaking, unless if like you're the operator of it, you're going to be subject to passive activity loss rules, which simply mean that because it's a passive activity, you're not actively running the show unless you are, then all these losses are going to be called just be passive and suspended. So that means that passive losses can only offset positive income. These passive losses won't offset your W-2 income because W-2 income's active. So just be wary of it, because it's like if you invest into a syndication and then, I see some pitches that are like, pick up 100K loss with your bonus depreciation. It's probably going to be stuck in a piggy bank that you can't use to offset your W-2 income. So just one thing to clear some confusion sometimes I see, and then depreciation flows through. So what I mean by the depreciation flows through is that the entity will take it at the partnership 1065 level. Then all of the depreciation will flow to you, aka the losses. So generally speaking, in syndications, always like, cool, grab it, run costs like the first year, pick up a fat loss, and then you'll bank that in and have that depreciation to move forward. So if you have a lot of other properties that have some positive passive income, such as you're doing like short-term rentals, or I'm even seeing on tax returns where midterm rentals are getting outpaced even by depreciation. So it's actually surprisingly causing tax bills that people are traditionally not used to, just because most folks are, used to the long-term rental style, where it's always more or less a loss. And then the big thing is anyone who's in a syndication, just watch out for the year you exit. So the year you exit, there's going to be a fat capital gain. So you need to plan on this. So if you're investing in a syndication, like talk to them, be like, hey, what year are we going to exit? Guesstimated amounts per your portion of it, and start planning for your life. Otherwise, you're just going to have like a huge fat bill that you're not aware of. So when they sell it, it's considered capital gains, and then you're going to have to pay income taxes on it. So how you can offset this though is, say if you have some capital losses from other type of investments. So say if you have, the tax loss harvesting, for example, you have some really bad positions, you don't see them coming, you rather just liquidate it, get the loss, they'll offset this capital gain here. So just watch out on the year that you do exit, because that's going to trigger like a not a happy bill, and you're just gonna be mad at your CPA or yourself on TurboTax. So syndications, those are just some items to watch out for. But overall, I think it's a really good way to get your feet wet into real estate, learn a lot more, have a group and community to tap into. It's just, tax wise, just watch out on your K1s and your other state returns. And what gets most people is that capital gains when they do sell it.
Does it help if we buy another or buy into another syndication that does the cost segregated studies? Will that help at all with
So you'll have the cost seg will help drive passive losses again, but passive losses offset passive income. So that's going to only net those out versus capital gains. You need capital losses to offset against. So that's where you really want to watch out for.
So how about I invest in syndication and I own several properties that I self-manage and I have income on, then will the losses from here, can it roll over to those properties?
Oh, yeah, exactly. Yeah, you always want to match the buckets. So if you have passive losses, always offset passive income. So your K1 losses will offset your rental properties that you self-manage yourself.
And then how about, does this relate to anything with what we have for stocks then, stock brokerages? Because say if I bought stocks or if I lost something, then can I somehow combine it with this stuff to lower my taxes?
Yeah, that's for on the year that you have that capital gains exit. Yeah, that's the year you really want to clean out your portfolio. So because you'll have a large capital gain that year, then you want to go ahead and toss that, liquidate those bad positions, do tax loss harvesting, sell off your losers, your bad performing stocks to help offset the capital gains. And also alternatively, you could also look into opportunity zones. So opportunity zones, not only can you fund it with properties that you're going to defer, you can also fund it with capital gains.
Cool. All right. And then
Cool.
there's questions in the chat room. Kevin asked, is there a cap to how much we can write off? He has a W-2 that is not real estate related. He owns rentals. Can he still write off real estate expenses to offset his W-2?
It depends per the series, but yes. So if you're if you make less than 150K of adjusted gross income, then those losses will go against your W-2. However, if you make more than 150K and you don't have a short-term rental, you don't have real estate professional status, and you're only a W-2, then it's going to go into like this piggy bank of losses that you bring into the future years. So there's not a cap to how much you can write off. So if you're, traveling, go ahead and write it off. It just will be probably locked into a piggy bank of losses until you have income to offset it, passive income to offset it.
Fair. And then Fong asked about these regarding K1. So if he has a loss on the K1, does it mean that he doesn't have to include it in our tax return? So kind of, for example, that you said it's not due or until September, but hey, I want to file my taxes now. I'm waiting on that last one. It's going to be negative. Can we still file first?
Yeah, you can always extend. You can always extend the return. And then if you forget the K1 completely, if it's negative, it doesn't really matter because the state's not going to care. So it's like, so when I worked at KPMG, I was always like, does this partner want to file 50 state returns or not? If the state return was like negative, like 10,000, like is it material or immaterial to you in that situation? So say if you picked up a K1 and it's like, $10 loss, TurboTax charges an extra $50 for an extra state return. Is it really worth it for you to file? That's kind of up to you. Like you won't be assessed a penalty against it if you don't file, just because it's like negative negative loss times penalty rate is nothing. So it's not like the state's going to pay you money. So we have people who evaluate that cost and they just don't care to do it. But if you have all the time and world and resources to do it, just file it, because how it's going to come back to help you in the future is that you'll have locked in this loss with the state. So when you do have state taxable income, it'll help offset that side. So it's kind of like it depends on your own personal thresholds for it. Generally speaking, I'm just like, meh. It's like, I don't know, a few $100. It's probably not going to add up over time, but so it's always up to you on that side.
Cool. And then my question is for, I'm working with you for those who are curious. I do work with Tony. So if I have a bunch of K1s and I wait until, a couple weeks to do, as a CPA, do you prefer that we still give you what we have so that you can get started and then give you the remaining K1s when it's done? Or do you prefer us to give your whole file kind of like when it's ready in September?
Generally speaking, it's always good just to like shove it in at one slot. But sometimes some folks are not as organized as you and then they'll just forget it. So it's like, if you know for a fact that you'll get all the docs in one shot, that's great. If not, just toss it in the portal before you lose it yourself.
All right. So if you guys see when Tony gets bald in October, September, you'll know why.
Yeah, Annie coming on 10/14. Be like, hey, I got my docs ready. Yeah.
That's right. Cool.
Right.
Thanks.
Sweet. All right, cool beans. And then let's see, next here we have partnerships and co-investing. So, if you're going to form a partnership with some buddies or invest with friends, what to like look out for. So the big thing, once again, kind of get the K1. So just always be ready for that K1, especially if you add in more partnerships, you're just gonna have to watch out, just to keep track. At one point, you probably want to like have a tracker actually. What I recommend is like, hey, what are all the partnerships that you're invested into? And then seeing that you got the K1, probably just start up a Google Sheet, list your partnership on one column, and then hyperlink that K1 for yourself, or create a little checkbox to know that you got that K1, just as you're growing your investing portfolio here. So partnerships, the cool thing about partnerships on like a smaller scale, on if you're investing with friends or you're just with a buddy or two, is you're able to do some special allocations. And what I mean by that is that, say if one person is like, hey, just get me in the deal, I don't need any depreciation, you just take it for finding this deal for me, then you can do this special allocation where one person, even though say it's a 4 people 25% owners, and say 2 people are like, the silent investors, where they're like, I don't want to do anything but write a check. And then the other 2 people are like, all right, cool, we'll go source the deal, do the PM work, take care of all the nitty gritty. And then the silent investors like, just take my depreciation share. So instead of allocating 25% towards each partner, just 2 people take that 50%. So you can really kind of set up these terms a lot like more flexible. That's like the beauty of partnerships. It allows for a lot more flexibility in the ways that you split income, losses, profits, and capital. So it's a nice vehicle for here. Another thing too is just understanding, like in here, like before I said that, generally speaking, you are passive in syndications. So you can actually be active in partnerships though. So you're able to control your fate more if you're the one operating that LLC. So you can have active versus passive classifications. So active ones are going to help, especially if you're a real estate professional. And that way, losses that pick up there, you're able to offset it. And then passive though, once again, like those passive loss activity rules are going to affect you again. So if you have, passive losses, just goes back to that piggy bank and you're not able to use it. However, active ones, you're able to offset it against there. And it's just, well, now you have an added return. So if you have a partnership return, you're going to have a 1065 that you're going to have to file each year. So just be aware of like more compliance. Even if you didn't form an LLC, technically a joint venture, you're supposed to form a 1065. And then also for folks that are married, I see this commonly like mistreated, or like they'll just go to like LegalZoom, register, go get an EIN, and then the EIN, they registered it as a partnership, even though like husband and wife can be like, disregarded for federal purposes, which simply means that you don't have to file a separate 1065 tax return, and you can just file it as on your 1040. So just watch out when you're like DIYing stuff, like you're just causing more headache than you need to be. And then that's what the IRS has on file when you file that EIN. It's like, hey, this partnership, I'm expecting a 1065 return. If you don't file it, I think it's like 210 per month per partner, up to, I can't remember, a couple of years. So the fines get pretty hefty for non-filing. So just be aware of that extra 1065 tax return you have to do. And then you'll have your basis tracking and distribution. So the big thing here for when you're tracking basis and distributions is your bookkeeping. So this is where most people, their books kind of fall apart during tax season. It's because they never did it and they need to scramble during tax season. So what I mean by basis tracking and distributions is this would go on your equity side of your balance sheet. And essentially it's like, hey, how much did you put in the partnership? Like 50K. And then how much did you take out as a distribution? That removes it from your account. So you say, I took out 5K. So now your basis is 45K. And then lastly, if you're going to have, positive income, like say plus 3K, it's an increase your basis to 48. So your basis tracking and distribution is going to matter a lot, because that's how much you're going to be able to write off. So if you join a partnership, you put in 50K, first year you pick up, sadly a 50K loss. your basis in that partnership now is zero, and any future loss will not help you. And if you do take distributions against it, you'll have a capital gain. So basis is really important. I think it's a commonly overlooked place that you want to be aware of. So more mechanics when it comes to doing partnerships or co-investing. We got a plug here just for fractional too. So for on the QR code, they have their Elevate program. So on the Elevate program, I think on Mondays, they just a bunch of you SARE folks just go in and analyze deals together. So, that's another way to easily get into a partnership together without having to, go through all the hoops yourself with you and your buddy. So, shout out to them for making it easy on that side. And the big thing too, from a legal aspect too, so where usually I tell people like, go run the Davis, like get an operating agreement together. I think that's kind of like the one overlooked part when you're forming up partnerships, because no one wants to pay more fees, or like the cookie cutters out of LegalZoom aren't the best. So, I always joke and say if marriages end up in over 50% of like in divorce, like just think about how it's going to work for you and your partnerships, with your buddies and friends. So just being having it protected for yourself is very important here. So yeah, partnerships, that's, long story short on that. It's just like, hey, 1065 return, always remember that. Don't mess up your EIN. If you do file your EIN, another mistake that I see people do is they'll like check all the boxes for like all the payroll tax returns too. They're like, oh, well, you have employees, and then they'll check the box and it'll be wrong. So just when you get your EIN, just make sure you just don't add payroll, add in 1065 if it's not needed. Otherwise, you're just going to have a boatload of compliance for no reason. And then just the flexibility of it. But with the flexibility just comes with that basis tracking distribution. Having a really good bookkeeper on the team is an important there. So that's partnerships, co-investing on that side. And then, yeah, I think that's mostly it here. We have just a little plug here. If you want to learn more on items, Davis and I are doing a little cohort. Just go further in depth of like more topics, just in a comprehensive way. So I have like 6 classes, like Q&A community, help network. So I'll talk about more tax strategies, Davis talk more about legal implications, and then kind of providing some checklists for folks on there. So yeah, other than that, yeah, open for a Q&A for anyone if they have anything more on the co-investing, partnerships, out-of-state investing. Overall, it's not too scary of a thing to do from taxes. If you're still DIYing it, TurboTax is still pretty solid. Just make sure that taxes paid to other state credit is there. Determine if you want to file K1s or not. And then you're kind of on your merry way. But it's an easier way to get into investing and not just, twiddle your thumbs. I know, like, was it 2 years ago? I think Annie was like, yeah, push yourself, go invest. And like, I think I got into crypto that year and I did nothing. And then the following year, she like kind of just silver plattered, her Georgia connects to me and was able to get in a deal. So it's like, all right, cool. Got a Georgia return to put on my taxes now, but it wasn't that bad to do overall.
Yeah, I have to do the Georgia thing too. We're on the same fractional deal, dude.
Yeah. So it's just like, all right, cool. Georgia is the state to be here. So, but no, it's not too bad. It's just more tedious work is all.
Right. And I'm actually really excited that you're doing this cohort because, a couple of years ago when we first started SARE, we were kind of just learning from each other, just reading a book, but it feels totally different when you actually have, your CPA, your legal friends who are trained in this to have these guided questions and telling you what are the most important things and getting you set up. So, and plus, like if I were to hire you or Davis separately, like by the hour, dude, I'd be a broke ass bitch. So I can't do that. So I'm glad you guys are finally starting this up. To really appreciate it.
Oh yeah, for sure. Yeah, just a little code left over from SareCon still. So a few $100 off on here. We're going to start this on, the September 17th. So a little bit over a month to go on here, getting some more folks, getting educated on here. And then also we got our own curriculum ready on here, but been asking for some more feedback just from like making it more tailored. Like we know what we want to cover, but sometimes we can't read brain. So happy to also include some special topics for anyone that joins.
Thanks. And can you tell me a little bit more about that formatting and the time? Like, is it once a week and how long is it? What are you using for this cohort?
Oh yeah, so it's gonna be once a week on Sunday nights. So we'll have it start on Sunday nights. Figure most people are gonna be less busy, about an hour to hour and a half, depending on how long the session goes. And then it's just gonna be overall, we got the lesson for there, go over it, make sure everyone understands the concept, and then open it up for any type of questions at the end too, just so people can kind of get more of a guided way, but more access to versus paying like a normal big, big attorney like Davis, since he charges way more than I do, a lot more access there. And then it'll be hosted all online through Kajabi. So right there within there, we'll have their community set, and then alongside with the videos that you just go in and just join, similar to like this webinar here, but just all on one platform.
And then if they miss a class or something, will they be able to rewatch this later on?
Yeah, so just for that time being, we're gonna have it available to watch, but then afterwards it'll be shut off on that side. More so, want to force accountability because we all know people buy courses and they just don't do it. So more or less like, hey, we want to just force people like come learn and actually do this. Own your taxes, own your legal situation, like in your own hands.
Great. And how is your Q&A and community networking part? How's that going to work?
Yeah, so right now we're just testing the features out in Kajabi, so they have like their own little community feature. So goal would be just if there's questions there, either students will be able to answer, or but me and Davis will just answer those ourselves if they're too technical. And then goal would be kind of just creating like, hey, this is Bob who does this, Jane who does this. It'd be kind of cool just like kind of build up this like community to see, hey, who's like the go-to person for there. It's kind of like the Rolodex. Oh, like the classic, like, hey, I think I posted this on today too. It's just like any agents in these three cities in Dallas or something. And I was like, needed like a commercial space for my friend's gym. But it'd be kind of cool over time. We want to build this little community where it's like your referral sources.
And what would you say would be like the target audience of this? Would this be for investors, just getting started? Do they have multiple properties, or are you leaning toward like more of people who are trying to get into real estate professional, or maybe agents that are already in the business?
Primarily more rookie and intermediate folks that are like getting in. They don't know what they don't know, but they know that they should be doing something. So I had, a few folks since SARE like asked me like, hey, I'm about to get started investing. What should I do? Like those folks that are kind of really ahead of the game from like, oh, they know that taxes are going to come back to haunt them. Legal is going to come back to haunt them. So once you're just starting, before you even start investing, this would be good. Those that are in here that are like, okay, I feel like my DIY stuff for like TurboTax is getting me so far, and I'm maybe missing out on some like strategies of like how to really change my taxes, especially real estate professional status, get more select strategies, at least from a tax side. So versus like, those that have a good CPA that's doing tax planning for them, definitely not needed. Like you wouldn't need this, Annie, on here.
Because I gave you like speed dial, dude.
Got Facebook Messenger all the time. Yeah.
And then other than this cohort that you're doing, so it sounds like mid-September to end of October, can we expect other cohorts to come up, or you have an idea of like how many like the times a year or the next one that would be?
So this one's going to be our first trial run on this one, and then I just want to make sure we kind of perfect this one. So it'd be cool do this one first, and then afterwards, get some good feedback, and then just go back, reduce if there's any like things that weren't great. Pray to God not. It was coming out with a banger here. And then the next one probably near December-ish / January would be the ideal. Once a quarter is kind of like our goal, just to help keep these cohorts going. People are getting educated. Because the biggest thing and where kind of the whole idea stemmed from is just like people know they need to do something, but they go through Google and Google just has some crap in it. And it's just like, form the Nevada LLC. You don't have to pay state income taxes, but like your property is in California. I'm like, oh God. So, a lot of this is just debunking a lot of myths that we wanted to do here.
That's right. It's like a very super condensed version of what we've been doing every single month, I guess, really on the Independence show. Just getting everything cleanly in order from, what's important and just to make sure everyone's set correctly.
Oh
So,
yeah, yeah. Plus, yeah, I think this the bonus on top is just, Davis and I just answering questions, for your situation, and you won't be, magically seeing thousands of dollars of a bill.
and then do you have like a maximum of students in the class?
This first one, we want to shoot for about a dozen would be ideal for here. So just seeing like, I think at that rate, I think we can have a lot of like one-on-one touch points. But after that, probably just cap it off here.
This is perfect because like if you have way too many students, they have way too many questions. Everyone has a different scenario. That'll be really difficult for you guys to, be able to tackle everything. But if it's a dozen like this, you guys are getting a lot more one-on-one and individual help plus that Q&A. So wanted you guys to highly, take a look at this and sign up for it because again, this is starting in mid-September. It's only about a month away. So make sure you guys sign up.
Cool, cool. Yeah. Well, hope to see if anyone's there. If you guys have questions about it, feel free to reach out too. I know saw some messages in Facebook I didn't respond to still, but I'm like, all right, getting there, getting there.
You're getting there.
Yeah. If I don't respond to you on Facebook, just send me an email. Was it? Oh yeah, send me an email. I'll respond to my emails. But yeah, Facebook I'm a little bit slower on.
Nah, you're still good on it.
Yeah.
All right, let's do have some more questions in here under the Facebook side. So why, and a couple of people, they were asking again about traveling and what's deductible. So just a quick reminder for those people is that if you guys are traveling and but to look at properties, but you did not buy, you don't have a property to peg it to, you don't get the deductibles. And then next question is, do I have to close in the same year? Say I took a trip to check out Florida this year, but I don't close until next year. That's still nothing to
Oh,
peg, right?
yeah. So you don't close till next year because you don't place the property in service, then you won't be able to deduct that in that year. So, but you can kind of like throw in a startup cost for the following year that you're able to take, which is up to 5K that you're able to take there. So do keep track of those expenses. Oh, actually, one fun thing. There's that really cool, interesting thread going on in the community. It was that person who had the 80 units who set up the PM company
Oh
for
yeah, that was an
themselves.
interesting scenario. Can you go over the whole story on that one in case people don't remember?
Yeah, that was interesting. Let me see
So, what the guy says is that he has 80 rental units all across, and and then of course the properties can either be an LLC or something. But the question was that if he has like an umbrella LLC where there's a holding LLC, can he, and it's still single person owned, can it be counted as like property management fees? Like if they say they take 10% for property management fees and how that would work.
Yeah, yeah. So that one is like it's missing a few more. Like obviously, we see that it was like talked about in passing. There wasn't the details. So yeah, I kind of like chimed in about that, but it's actually quite interesting because everyone in like is always very creative in their structuring, and there's like a couple scenarios that this could work and it would not work. So the first one is that if it's one person only, then it's kind of like it's a big circular loop, and unless it's taxed as a S or C corp. So say if that main company is like a C corp or an S corp, then your tax rules actually change because C corps, the income doesn't pass towards owners, it pays a flat 21% tax. So if you pay a PM fee to your C corp, and then the C corp's able to write off, pay your, put in your 401k, pay for travel, pay for meals, like kind of like an operating holding company, then this works and kind of helps you. But if you don't near zero or you go negative, like, or you're zero or positive, it doesn't really help you because then you're paying 21% tax for no reason. The other thing too is like if you're using a C or an S corp to do some income shifting. So say it's not only that one person, but like this person hired like their kids or their mom and dad or their sisters, brothers, or like the broke friend, and they pay the kids to shift it into a lower income tax bracket, then this would make sense for this structure. So those are like a couple unknown variables, but it's a very interesting one because like the C's and the S corps make sense. If it's just a straight LLC, it's not going to do anything for you. Just because if you think about it, LLCs are pass-through entities. So what I mean by that is like if this LLC picks up $10 income, this other LLC subtracts $10 income, and it all comes back to me, it's still net zero at the end of the day. So if it's just a one-person LLC, then it doesn't matter. Once again, the answer changes again, though, if you have a multi-member LLC, because then what are the other members? What are their income tax rates? How are you doing special allocations that we talked about earlier tonight? That can change the answer too. But at the end of the day, too, like this better be worth it, because you farming a couple LLCs is probably going to cost you a decent chunk of change. You filing a couple extra business tax returns each year is going to cost you, a chunk of change. So this person at like 80 units, yeah, of course it makes sense. But, for some chump like me who has like one, like it wouldn't matter, right? So it always is, it depends on your situation, but a very, very good fact, at some certain points, it's you may want to move into the structure. Long story short, it's if you have some income shifting you want to do, if you want to do some funding through insurance, like you want to hop into the whole Midas Wealth gang too, get into those, life insurance policies. This is another way to write it off. So C Corps will do executive bonus plans for the employees. That way you can buy life insurance on the key employees and key executives and get a write-off. So there's many ways to structure it. It's just like, what cards are you dealt? So it was a good thread. Whoever that is, like, kudos. I think it really got the community like talking about it.
And then if kind of expanding more on it, say if they've changed it to one of the C Corps or S Corps, there's an employer component. Does that mean then they can also do like the the SCP IRAs, like the self-employment, and even potentially turn it into like a self-directed IRA or something, just to get another tax deductible stream of income?
Oh yeah. Because you could probably hack it even further, because it's like, all right, you got the C Corp or the S Corp. You can do the SEP IRA or the solo 401k or the traditional 401k. And then on those two, since you're an employee, you're the controller of it, you could do a mega backdoor also on top of it. So, 401ks, I think the limits is 22.5K as the employee, and then you can do 25% up to 66,000 total combined. So you could toss 66 grand, you have to pay yourself like $250,000 though. And there's a lot more payroll taxes, but you could shove it all into here. And if you want to roll it into a self-directed IRA to go invest in real estate, that'd be fine also.
Oh my God, we're gonna have to plan another session just on this part. That's like so cool and so detailed.
Yeah. So there's a lot. Yeah, I think it'd be interesting if anyone wants to be like a use case or something. We just like analyze, like maybe that's like a next one where we should like pick a winner out of this, and they're the use case. I don't know if anyone wants to share their money though. Also, there's an interesting thing, like my buddies and I are talking about. It's like, does it really matter how how like money talk is weird between people, and like no one really.
Not unless you're Asian like us.
Yeah, and it's just like, does it really matter if someone knows how much you make or not? Does that change anything? So I don't know. It was an interesting conversation. It's like, well, if Bob makes 100,000 or he makes 1 million, it's still Bob, in my opinion. But
It
it
could
may
be a
change.
culture thing too, though. Like whoever makes more should be the one to pay if we go out.
There you go. There you go. Yeah. So, but yeah, if anyone wants to be a use case per their situation or some like crazy hypothetical, I think that could be a good fun or add to the mix also. Because I think we still have, is it one slot that we don't have a predefined topic on?
Yeah. I think it's on end of November. So maybe that could be something we can think about doing.
Yeah, like one lucky SARE member becomes like the use case. If you
Pick
want to
one
share
then.
their portfolio.
It'd be awkward.
Yeah. Uh-huh.
I do
Yeah.
have another question in here from one of the members regarding about deducting for travel.
Mhm.
So, and this is regards, I think this person is trying to do the real estate professional, which has the hour limit.
Yep.
And he asked if we're able to claim hours, say if you're traveling, say from one destination to another, or for the flight time, does that count as part of the necessary hours to become a real estate professional?
So generally speaking, if you're a real estate professional, that would be your main craft, because over 50% of your time is dedicated to, one of the core activities. So generally, if you're hacking it though, so the general rule saying is that we have point A, point B, point C, and home, right? So your destination from home to point A is your normal course of work. and you drive back, you don't get to deduct any of that. However, if you go to point A and then you're like, oh, I got a showing at point B and I got a showing at point C, the trip from A to B is deductible, B to C is deductible, but then C to home is not. So essentially, the leg to your first place and the leg back is always not deductible. But since we're clever Asian folks here, your home office is your first place of destination. So, AKA, you wake up, you roll out of bed, you're at your home office already. So you did your travel for the day. So then now A, B, and C are all deductible because your home office is your principal place of business. So you can write off all those stops. And then in terms of the hours, though, it's like, hey, were these hours dedicated towards doing one of your activities? So let's just pretend this person is a real estate professional in the realm of management, right? So they're managing the properties, they had to go visit it, then yes, these hours count towards that because they'll count towards the 750 / the material participation, the 100 hours or 500 hours, and then do your grouping. So depends on what unit you are, but like if you're a real estate professional in like the development space, but you're just traveling to go to SARECon, like development as in like you're building a house, that type of development, not developing relationships, just to clarify.
Then how about for real estate investors or that are REPs and they're looking for acquisitions and then they have to fly to different cities, check those out. They could have bought it or not, pretend, for example, Nelson, he has to go fly to all these cities to go purchase. Then does the act of traveling there, like the time or going in between those properties, does that count for his hours?
Yeah, for if you're specifically in acquisitions, yeah, because it's like, oh, hey, you're meeting with this business person to close this deal, get funding, or check out properties in that arm of it. Yeah, so it's like, what of the seven? Is it 7 categories or 12? I can't remember which one it is. No, it's like 12 or something. Is your specific rep?
Mhm. So
Mhm.
that's interesting because it's not deductible since I haven't been able to purchase the properties. I can't expense it, but hey, it's still useful, for this trip in another way in terms of hours and still deductible from your real estate business as the active business, not the
Oh,
passive business.
yeah, yeah. So yeah, I think that's always the fun thing too, is like always seeing what of your personal expenses that are business ones, of course, that have a real, business use, ordinary and necessary. But even as you get into it, it's just like, hey, the travel, the meals, the car, those big things that you use in everyday life, all your software programs, your Adobe, your Apple iCloud, all this starts adding up a lot, especially, if you're more in the agent space too. Agents that aren't S corps, you probably should highly evaluate that. A lot of folks that I see that, aren't, you're probably missing out a ton there. But yeah, just more of a home office side too. And, fun fact was like, if you do self-manage, you can actually take a home office deduction on your Schedule E. I think that's commonly overlooked too, / I don't think TurboTax asked that question directly. So a little bit more items, things I see.
Wonderful. All
Cool.
right, so we're kind of at the top of the hour. It's 7 o'clock. So to wrap things up, I'm going to let you guys know that this month we still have a couple more workshops to go. And for this month, I'm really focusing more on like the taxes and the legal part so that you guys can, start off this fall with the great plans. So on August 24th, we have financial planning for real estate investors. And then on August 31st, we're going to have Davis come back and do why do you need an operating agreement? So be sure you guys tune in for that. And for those who did not go to SARECon, you missed out. But if you're in the Bay Area, we're going to have another event coming up soon on September 23rd for those in San Francisco. I am co-hosting an event called Invest Now. This is done by one of the really reputable brokerages in the Bay Area by Sequoia Real Estate. They've been doing it for 5 years. I've attended for the last 5 years. It's where I met a lot of the agents who ended up helping me invest out of state. So this one is just for investors. This will be held on September 23rd in South San Francisco. So if you like to come, definitely come on over. I'm also going to try and rope in Tony to come and hang out, but on the weekend, it's really hard to pry him out of, his little hermit cave. So I'm going to try my best. And then there's a couple other things that are going on this weekend in the Bay Area. We have a potluck coming on this Saturday. That's in San Jose. And then next Saturday, we're also doing another event in San Jose. We're going to learn how to mix dumplings together. So come on, hang out, make some new friends, learn new things. We'd really, just love to spend more time with our community. So if you guys ever have any questions about taxes or real estate, definitely hit up Tony and Davis, and I'll see you guys very soon in a couple more weeks. See you guys soon.
Guys,
Bye
thanks for having.
bye.